Hey everybody, what's happening? It's Bill, take two. I think the first time my video was, or my phone connected to my Bluetooth, which wasn't in the same room. So anyway, hopefully the audio's working this time. Really quick, so I just wanted to talk about, I'm definitely seeing a bunch of investor activity over the last couple of months, and it's worth pointing out. I mean, I've got, and kind of what I'm seeing is these investors that they're just looking at their current properties that they have, their current rental properties, of course, and they're seeing that maybe they've kind of hit a bit of a peak for now, and I see them taking that cash off the table, and now they've got a big chunk, and then they're going buying 2, 3, 4. I even had one client just a couple months ago that closed on 5 properties. Just from the sale of one, right? And so why would you do that right now? Why does that even make sense? Well, so for starters, each of these have utilized a 1031 exchange, right? So for anybody that doesn't know, that means you get to take the full amount and defer the taxes, right? So whatever you net out of the property, and if you don't use a 1031 exchange, then you pay your capital gains now, and then you use whatever's left to reinvest if that's what you're going to do. Whether you're going to invest in real estate or whatever you're going to invest it in, you're going to use after-tax dollars. A 1031 allows you to take the full amount, reinvest it, and then from there, now you defer that tax. So when you sell the next property, you either 1031 again, or you can pay the taxes then. Lots of planning to go on there, but that's what all these clients recently have done, is utilize a 1031 exchange. And so, and then they take that money again. You take one property that's gaining equity at 20% or 5% or whatever they're doing. It's been 20% the last couple of years, right? But a more normal just appreciation for most areas is in the 5% range. And so, but now you put that over 2 properties, it just gets to go up that much faster, right? I mean, it's simple math. So it doesn't go up faster, but it's spread over more property, 5% over $1 million versus 5% over 500,000, let's say, right? So you can see how that works, and the nice thing is that properties will still cash flow. I am not a proponent of suck out all the equity and reinvest it and buy as much as you can. You've got to do this in a really sane way, but doing it right, taking a long approach, and finding good quality properties is really the key to this, and I'm seeing a lot of investors do it right now. Yeah, it's a little bit of a wonky time, right? We've got prices up and interest rates are up, but investors are just looking at it very straightforward, right? It's like, look, I mean, can I get cash flow out of this thing? And does it have a long-term prospect of continuing to increase in value, regardless of what happens for the next couple of years, right? Because what happens in the next couple of years is all about cash flow. Doesn't matter how much the property is worth until you're ready to sell it. So again, a long-term view on this, and I'm seeing a lot of investors take advantage of resituating things. So for anybody that's either looking at buying their first investment property or potentially looking to 1031 into multiple properties or even just a bigger property or whatever it might be, I'd love to have a chance to run through some numbers, help you see what it really looks like, and figure out if it makes sense. It's not going to make sense for everybody, but there's a large chunk of people out there that have so much equity it can make really great sense. So I am Bill. I'm with Franklin Loan Center. And please like, share, comment with any of your investor friends, and I'll see you all next week.